At first blush, the bank's interim results seemed pretty good, with the Big Four's profitability up 7% to $12 billion. But those figures were helped by a decline in bad debts, while quality revenue growth and improved lending margins were hard to come by. In a moment, I'll talk to ANZ Chief Mike Smith about that struggle. But first, Neil Woolrich has a look at what we learnt this week.
Look, I'm certainly confident about Australia's economic growth outlook. I'm certainly backing Australia into the future.
In many respects, the economy probably couldn't withstand an interest rate rise just at the moment.
I think that the economy, as I say, is multi-speed right now, and I think it would be difficult to put a brake on.
It's a biannual ritual where the banks provide a deep scan of the internal workings behind their multi-billion-dollar profits. But the bank reporting season is much more than that. It also coughs up detailed results about the health of the broader economy. The prognosis this week was reasonably good, given the infirmity of other developed nations. But there were some troubling spots found which could turn rather nasty.
I really don't think there's anything to get particularly excited about in these results.
There's substantial concern, of course, over loan growth, in particular what might happen to residential lending. We've been waiting for some time for corporate lending to pick up.
After investors pored over pages of results and analysis, the National Australia Bank looked to be the preferred stock this week, with NAB's share price the only one to bounce on the release of its results.
The media is reporting that it's largely driven by the personal bank, whereas when you actually look at the numbers, it's largely coming through in the business bank, basically where repricing continues to drive the margin up, and they've had a very good cost outcome, and once again you've seen a much lower loan loss charge.
In the March quarter, their margin actually went up, notwithstanding the fact they had high levels of growth. Westpac had the lowest level of growth but the best margin outcome, but because the growth was low and they had very little in the way of trading gains, they seem to be the biggest loser in this most recent reporting period.
On the other hand, ANZ was buffeted by the high Australian dollar, which trimmed some of the profits from its Asian business. Another drag at home for all of the Big Four has been the tepid rates of growth in business lending, which is only now showing signs of recovering.
It's really been only 2 months, and it's been quite modest at this point. So I think we'd like to see more in a sustained way.
Part of the rebound we're seeing in business credit is actually because in many cases we've had negative system growth and businesses are actually dealing with some quite critical investments they need to face into, having not invested in the last couple of years. So even that would not necessarily be impacted by an interest rate rise.
CLSA's Brian Johnson says credit has been growing faster than GDP for much of the past 15 years, a situation which can't continue indefinitely.
This time around, most of that excess debt seems to have been funneled into households, and the end result is that as interest rates rise, people are having a lot of trouble basically keeping their consumption patterns up and paying off the home loan. So the end result is that everything slows down.
Another concern for banks and for policymakers is how consumers will behave in the months ahead. This week's bank results reaffirm that households remain cautious, saving more than they have for decades. But they also point to an alarming rise in home loan arrears, albeit from a very low base.
If they stay where they are, it's not a concern, but the problem is the trend. The trend is increasing, and it has a couple of impacts. While the impact may not be that large for bad debts, it may indicate that residential loan growth is going to be an issue going forward.
But what I do find disturbing is that when you have a look at the increase in the arrears rate in mortgages, for example, Queensland was basically escalating sharply quite a long time before the floods. And on top of that, it seems to me that the escalation in the arrears rate is evident in pretty well every geographic domicile in Australia.
I think we can cope with one further interest rate rise later on in the year. I wouldn't like to see two, and especially not two in a row.
One threat the banks won't have to worry about for now is government intervention. With little fanfare and perhaps even less in the way of meaningful reform, the Senate Economics Committee tabled its report into banking competition on Friday. BBY banking analyst Brett Lemessurier says there's little the government can do to make the industry more competitive.
The reality is the regional banks are minor players in the Australian banking landscape and will continue to be that way. And while there is much hype about the fact that they are at a competitive disadvantage, the reality is that they don't have that much of an impact.
What creates competition in banking is financial markets. The fact is, with securitisation markets where they are, with the spreads where they are, I think it's going to be very difficult for those smaller non-bank players to come in, which means I think we have the situation where the banks continue to enjoy this nice oligopoly that we see.
The Senate committee has tabled 39 recommendations, among them for another broad-ranging inquiry modelled on the Campbell report of the 1980s and for the government to reconsider its ban on home loan exit fees. In other words, back to square one.